Welcome back to the channel, guys. My name is Warren. I am a banker here in London and property investor across the UK. My goal is to live free from property in the next 5 years. So my goal from property is £3,000 per month cash flow in the next 5 years. So guys, let's get straight into the July 2022 UK housing market update. That's what you're here for. Right now, we are in a seller's market, guys. It is incredibly difficult for buyers to find a house because there is an over demand and undersupply, which means that sellers are in the best position when it comes to the housing price right now. People are bidding over the odds for houses, and houses are reaching prices over and above the listed asking price. And if we have a look at the Rightmove index, the average time to secure a buy across the whole of the UK, right now we're at 32 days, which is the second lowest that it's been in the past 12 months. The lowest was just last month. And very similarly for London, I like to differentiate between the rest of the UK and London because London is a bubble, but we can see here that London is following suit. We're actually at the lowest that it's been in the last 12 months at 47 days. And to put this into further context, we can actually have a look at an article from the Telegraph that expands out over a longer time period. We can see here that it says properties are being sold in a record 33 days, despite the rising interest rates that usually do affect the UK housing market in a negative way and the soaring inflation. This was actually down. This 33 days is down. It's less than halved from 67 days in the same month in 2019. So for those of you who remember what life was like before the C word, not that one, came into the world, the global health pandemic, before the economy took a big hit, on average it was taking around about 67 days, 2 months to secure a buyer, and now that is halved because of the over demand and undersupply. In fact, guys, I talked to a lot of investors. I was up north earlier this month with a guy who's very active in the north of the country, and he was telling me that a lot of properties that he gets because of his good relationships with estate agents aren't even making it onto the market. They're getting sold off market. That's how hot the competition is, guys. What have been your experiences in the housing market? Are you trying to move right now? Have you been gazumped? Are you having offers being turned down above the asking price? What is the competition like in your area? Let me know in the comment section below. I'm looking to go back into the market and buy another house in the next few months, so I want to know what it's like out there, guys. Tell me what it's like in your areas of the UK. And what I think is really helpful, guys, and what we all should be looking at right now if we're looking to buy a house right now, is some tips on how to successfully secure a property in a seller's market. So this article by the Homeowners Alliance talks about how to succeed in a seller's market, and there are a few key areas that I think are worth looking at in a bit more detail. The first is to act quickly. So right now there is a lot of competition between buyers. As I mentioned earlier on in the video, there's huge risks of being gazumped. For those of you who don't know what gazumping is, a gazumping happens where a seller agrees verbally to sell a property to a buyer. So that buyer's, gone and got their mortgage in principle together. They've gotten all of their funds together, and then the seller at the last minute says, hey, I've got a higher offer over here. The agreement that we had is no longer on the table. Bye, Felicia, and they go with the higher offer. And that happens in a hot market where there is high demand, such as the one that we're seeing now. So we're seeing that a lot. So speed is of the essence. You want to act quickly once your offer is accepted, as this article says here. So stuff like having your documents in order. When you look to try and agree a mortgage in principle, ideally you want to do that before you've made an offer. But once you've had your mortgage in principle agreed, then the lender has to underwrite that offer, and they're going to ask for more documents like work contracts, pay slips, bank account statements, and all of that good stuff. You need to have that ready to go because there could be somebody else circling your planned purchase like a shark with a higher offer, and that's ready to go even quicker. So speed is of the essence, guys, in this kind of market. The second thing we need to look at is buying in a chain. Now, if you're buying in a chain, that can be a big problem for sellers, especially in a hot market, because it means that as a buyer, you need to sell a property first before you can buy the property off the buyer. And that's not always appealing to a buyer because that means a possible or potential delay in the process. So if you're able to, especially in a hot UK housing market, break the chain if you can, sell first and then go on to buy, because you're less likely to get gazumped. And also, we're seeing right now instances where buyers are actually taking lower offers from buyers who aren't in a chain above higher offers from buyers that are in a chain, because they perceive it as a more appealing offer that's more likely to get finished quicker and less stress and hassle. So break the chain if you can. And then lastly, probably the most obvious one is to do with prices, guys. As I said before, in the UK housing market currently, there is high demand and undersupply, which means prices are rocketing upwards. And at this moment in time, people are paying over the odds for houses on the market. And in the same article by the Homeowners Alliance, there is a stark warning that we should not be paying too much for our properties because competition is so high. Especially if you're buying as an investor, if you're looking to be a buy-to-let landlord, it is essential that you do not pay over the odds for a property because it's going to destroy your returns. So the properties that I was bidding on back then, I was able to underbid and get accepted on those. Right now, that would not work on the types of properties that I bought then if I were to buy them today, because there's so much competition. We're competing with other investors, but we're also competing with home buyers. As I said at the beginning, there's an undersupply of UK housing. So investors are actually bidding against home buyers that want to live in the properties because there's not enough to go around for everybody. So they're more than happy right now in this current market to bid against investors. So guys, it's more important than ever to assess the returns, do the right research and ensure that you're paying the right price for your property and getting the returns that you need. One tool that I really love that does this for me, guys, is Lendlord. So guys, what I really want to show you is this deal analyzer tool from Lendlord. It's an online portal and it's absolutely free, guys. This is a great thing about it. I've navigated to the screen here. All you need to do is input a few metrics such as the purchase price and the costs, the closing costs, and a few assumptions. It's great because you can actually add assumptions such as the growth rate that you think your property is going to grow by each year and the rate of inflation. That's really important, and we'll come to that in more detail in another video, why beating the rate of inflation in terms of getting returns that are higher than the rate of inflation is essential. But here is the screen. These are the fields that you need to put in. And what I'm going to do is I'm going to pop to one that I've done earlier. Here's one that I made earlier. And what I put in here are actual figures on a real life deal that I was looking at not so long ago. And let's have a quick look at how this stacks up in terms of return and what this is telling me. So I've put in the purchase price, the stamp duty gets calculated automatically, the expected rent, the closing costs, the details of the loan, so how much of a deposit I'm going to put down versus how much of a loan that I'm going to need, the service charge and ground rent because it's a flat, and some stats around long-term assumptions that I'll go into more detail in a second. But what I really want to draw your attention to, guys, is the first year metrics. So net annual cash flow. This tells me, just by putting in a few metrics, how much money I'm going to be getting per year and per month on this property. So £1,700 per year based on the amount of rent that I expect to get minus the monthly expenses as well as the interest rate on the mortgage. I'm going to ignore the cash on cash and cap rate figures right now. The metric that I really use that is key is a return on investment. This is a return on the amount of money that you put into the deal. That's the stamp duty, the deposit, the closing costs, all the fees, the lump sum of money in cash that you put into purchasing the property. What's the return that you're going to get on that? This for me is the clearest return measure that I like to use on all of my property investments, 7.53%. Now, as a starting point, I aim for a return on investment that is greater than the average inflation over the last 5 years. Over the last 5 years, the average UK inflation has been round about 2%, as you can see on screen from the light blue CPI inflation rate here, around about 2%. Yes, inflation is doing an absolute madness right now. It's at 9%, but this isn't reflective of the long-term average over the last 5 years. So a return of 7.53% is way above the long-term average inflation. So there's a tick there. And in fact, it's above most of the other major asset classes right now. If we look at 10-year bonds, they're at about 2.5%. Interest rates on savings, guys, we're talking under 1%. The stock market over the last 5 years has done pretty well as well. But overall, by putting in these simple numbers into this deal analyzer, we can see that it's going to be a really healthy rate of return. Now, if we go over to the longer term metrics, in the assumptions, this is where these come in. I've put in an occupancy rate of 90%, which works out to the property being tenanted around about 11 months of a 12-month year. So I'm putting in 1 month for voids, which might be a bit optimistic. Annual property price appreciation, again, over the last 10 years, the average rate of growth of property has been 6.8% per year. Rent appreciation, according to the Office for National Statistics, has been 1.5% per year. And as we already talked about, annual inflation. And I want to see what my returns, long-term metrics are going to be over a 10-year period. So you can play around with the period here, but I've chosen 10 years. Now with these assumptions inputted into here, I really want to draw your attention to the equity figure. And if I get a breakdown over the 10 years by clicking on this, we can see that the property value is going to grow at 6.8% per year using that assumption. So by 10 years from now, and by the way, guys, my strategy is to hold my properties for my entire life. I don't plan on selling an asset that goes up by 6.8% per year or greater and produces a consistent income. Other people flip and they do other strategies, but for mine is to buy and hold for life, guys. So over just the 10 years from now, we're seeing that the property price is expected to go up from £98,000 to £189,000 by year 10. The mortgage is going to stay the same because don't forget it's an interest only mortgage. So the capital amount is going to stay the same throughout the term of the mortgage. And as the property price goes up and the mortgage balance stays the same, the equity goes up. So by year 10, we're looking at a potential equity of call it £128,000. And of course, net cash flow, as rents grow up by 1.5% per year, the cash flow is going to go up as well. We're potentially looking at £2,183 per year in income. So guys, that is a really quick demo of a free tool that I use to assess some of my potential investments. You can input these numbers in a few minutes and churn out these key metrics. You can do it on a laptop or your phone. Really good tool that I use to make a judgment on whether I should buy or not and to inform what price I should be paying for the asset. And then lastly, guys, let's look at some news, big news as it relates to the UK housing market. The Bank of England has chosen to remove the affordability assessment for mortgages. So what does that mean? If we look at this article from the Bank of England, we can see that the stressed interest rate assessment that lenders use to assess whether a borrower is able to repay a mortgage is going to fall away. And for those of you who don't know what that is, when we buy a property and we take out a mortgage, we pay an interest rate. We either get a variable rate or a fixed rate. A lot of landlords, such as myself, choose a fixed rate so that we know what we're paying. What lenders do is that they add a few percentage points to the agreed interest rate to assess whether you could still afford your mortgage in the worst case scenario if interest rates rise. And this came in as a result of the 2008 crash in the global economy. We won't talk about that right now, but the Bank of England and other regulators globally introduced a lot more stringent rules around lending, especially on mortgages after that global meltdown. Interestingly, the flow limit will stay, so mortgage lenders tend to not lend more than 4.5 times your salary. And what it's saying here is that if a mortgage that you're going for, if you're a borrower and you're going for mortgages that are greater than 4.5 times your salary, there are going to be limits on the amount of mortgages which you can get overall. So they're not going full gung-ho and taking all of the measures away. But what do we think, guys? What do you think about how this is going to affect the market? Is this a good or a bad thing? I have some personal thoughts. I'd love to know what you think in the comments, but let's have a quick look at an article from the Times. Lewis Shaw of Shaw Financial Services, he thinks that the change is going to increase demand. It's going to push up house prices. Why? Because we already have a over demand and under supply of property. So if you take away one of the barriers, and it's a good barrier, by the way, that prevents people from getting mortgages, more people are going to now qualify for mortgages, and that means that there's going to be more demand. And Lewis Shaw's assessment is that it's actually going to push up prices even further. And we already know, guys, that prices are already doing a madness in the UK housing market. So his assessment is that this is going to make the situation worse. It's going to increase demand and the market's going to go further out of control into a potential bubble. Now, the balancing argument for this, guys, is that we're currently in an environment where interest rates have gone up to 9%. So mortgage rates are likely going to go like that very soon, and people are going to be paying more. So when you add a stress test to that, the affordability tests are going to be really unattainable for most people. So in theory, a lot more people are going to be denied mortgages who want to buy a property because they just won't qualify from the affordability test. And then add to that the rising costs of fuel and household goods and inflation. It's going to be hard on a lot of people, guys. So there's a balance, there's arguments for both. Let me know what you think in the comment section below. So guys, that was the UK housing market update for July 2022. Let me know what you think in the comment section below. I am now on TikTok, so follow me on TikTok, follow me on Instagram, and I'll see you guys soon.